Egypt alone accounts for nearly one-third of this total, followed by other major economies such as Angola, South Africa, and Nigeria. Let's talk to Patrick Ba Abankwa now, global investment analyst, joining me via Zoom. Great to have you on the show.
Thank you for having me. It's been a while.
Yeah, it's great to have you. Happy New Year. So, how should we interpret this increase, in external debt repayments to over $90 billion? That's for 2026. What does this tell us about the sustainability of African sovereign debt profiles?
Thank you very much. For me, this isn't a surprise. I think it's more of a scheduled peak that requires invasive management by the various countries that are indebted around this time. When we talk about 90 billion debt war in 2026, we have to look at the context. For me, this is essentially the bill coming due for the massive Eurobond era of the last decade. And it's more than triple what we saw in 2012, as you rightly said. But for me, as an analyst, I don't look at the 90 billion as a single column. It is highly concentrated. It's highly concentrated. I think Egypt alone is responsible for nearly a third of the 90 billion, which is around 27 billion. If you add that of Angola, you add that of South Africa and Nigeria, you've accounted for the lion's share. So the question of sustainability, for me, isn't just an African question. It's more of a country-specific liquidity question. The sustainability, as you rightly asked, for me, depends entirely on whether these countries can maintain access to international market to roll over this debt over. If the refinancing door stays open, I think that countries can easily manage. If it slams to them in terms of the door, then they are likely to suffer from some global shocks, which can become a problem for this country. So for me, it's more of what they are going to do beyond that. If they are able to get access to the international market to roll over some of these debts, then, the economies will continue to experience what they are experiencing now in terms of the soft nature and in terms of the sustainability that we expect from them. But if the international market is shut down to them, then some of these countries will begin to go into some difficulties repaying some of these Eurobond loans.
All right, so I guess you're saying it's not really time to panic, right now. But, despite the high debt levels, why are average sovereign ratings, why are they improving? To what extent do these ratings reflect, real progress, versus, temporary stabilization?
Ratings, I would say, are rewarding policy pains for me, but the structural health lag still is behind us. Sometimes it seems like a paradox where debt is at its peak, yet you see rating agencies like S&P and others nudging ratings upwards to levels we haven't seen sometimes since 2020. Why? Because ratings aren't just about how much you owe. They are about your ability and willingness to pay. So what we are seeing is a reward of what I would term policy courage. We've seen countries like Nigeria and Kenya making very difficult, very unpopular fiscal choices, such as removing subsidies and tightening their belts. This has stabilized the credit story of these countries. However, I need to be very clear. This is stabilization, not transformation. We are moving out of the emergency room, but we aren't yet running the marathon. The true progress of what these countries are going to face requires these reforms to transform into a wider tax base. Once we get to a wider tax base, not just higher interest rate, then we'll be able to attract short-term capital, which will make the country's sustainability more stabilized. So, in short, what I'm saying is that ratings are not just about how much we owe, but it's about our ability and willingness to pay. And if the various governments show that they can pay, then we continue to see the ratings nudging up.
All right. So what would you say are the structural vulnerabilities in some of these African economies that make them especially sensitive to hard currency debt repayment pressure? Because we've seen the likes of Ethiopia, they have that deal with China, where some of their dollar debt is converted to yuan. And, we've heard reports that they're saving, from such conversions.
Yeah, I think that the fundamental vulnerability in Africa's debt remains the currency mismatch. That's always been the challenge. And that's why in economics or in finance, we call it the original sin. It means that you are borrowing in hard currency like dollar, but you are generating revenue in the local currency. In this case, it can be CD, it can be Naira, or it can be any other currency in Africa. When the Feds keep their rate high, the dollar stays strong. We all know that. That means that even if a country doesn't borrow a single cent from them, their debt to GDP ratio can worsen simply because their local currency has weakened. And if you couple that with revenue concentration, where a dip in oil and cocoa prices can wipe out the budget surplus meant for debt servicing, you have a recipe for extreme sensitivity to global market shift. So we need to move towards more local currency financing, which can help us to break this cycle, because so far as we continue to borrow in hard currency, any fluctuation in the currency that we took the loans from can have a positive or negative impact on our economy and our ability to pay some of these loans.
So from an investment perspective now, how might these, debt dynamics influence, FPI flows, into African sovereign or, some of these corporate debt markets?
From an investment perspective, I think that the African rising blankets narrative is over. We are now in an era of extreme selectivity. Foreign investors are no longer buying the whole continent. They are just picking the countries that are winning. So they are picking winners. They are looking for countries that are more proactive with liability management. If a country waits until 2 months before a bond matures to figure out a plan, investors are not willing to come to you. They'll flee from that country. But if a country, as we saw with Cote d'Ivoire, Benin, is out early doing buybacks and maturity extensions, even with Ghana, then the market rewards them with sticky capital. We should expect higher for longer yields, which means that only the most disciplined sovereigns and the corporate will find it affordable to tap into the market. So that's where we are at the moment. And investors are now being selective, and they are looking at those that plan ahead and not those that will just jump on when things are getting very, very bad.
All right, so much to unpack there, and definitely we'll still keep tracking, how, most of these countries are able to, pay back, most of this debt and, spend money on other things that that would help, Africa actually progress and industrialize, further. Thank you so much, Patrick Bar Abankwa, the global investment specialist. Thank you so much for coming on today.
My pleasure.